Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Today we are talking about waterfalls. Paul, Managing Director of AAA Storage, what is a waterfall? Why the heck is it called a waterfall? And why should anybody care?
Yeah, well, waterfalls are basically the governance around how distributions are made from partnerships or LLCs. And interestingly enough, Brandon, the name, if you can get this visual, we don't have a visual to show you, but if you can imagine a series of buckets that are stacked, sort of offset from each other. If you start pouring water in the top bucket, once it gets completely full, the water spills out and goes into the second bucket. And as you
like
keep
one of those
pouring water,
champagne tables.
Yeah, exactly. And so when the second bucket gets full, then the water that's coming out of the first bucket and the second bucket starts running over into the third bucket. And that's essentially how the waterfall works. You start filling, you set the priority of which buckets get filled first and then what order they get filled in and how big those buckets are. So that's where the name comes from. I don't know that has a ton of value, but I think sometimes it's always fun to kind of know the origination of how something gets from. But essentially, they are the rules. And I think probably most people are familiar from looking at them in the private placement memorandum, which is they're generally described in the private placement memorandum, but it's actually part of the governance structure. So the real detail on a waterfall and how it works is actually found in the limited liability company agreement, or the LLCA, or whatever the governing documents are for the entity. If it's a limited partnership, it would be a limited partnership agreement. But the governing docs, in fact, for example, in Growth Fund 2, the description of distributions and the waterfall can be found in Section 6 of the LLCA. And that is the legal governance, very detailed language that it actually governs. What you see in the PPM is simply sort of an overview, a description. It's adequate enough to understand it, but and why it matters is it's essentially, and every investor should, and I think most do, look at the waterfall structure if they're considering making an investment, so that they understand the priority of those distributions, what share is the sponsor getting, and when is he getting it? And does that feel fair and right to them given this particular investment? The waterfall is there to protect investors, but also to act as the incentive compensation mechanism for the sponsor. And certainly as an investor, if the deal is really heavily feed up front and the sponsors appears to be making a profit on the front end, you would expect the back end, the waterfall, to be a little more generous to the investors. If the sponsor defers any real benefit at the beginning or early in the investment's life and is predominantly dependent on the success of the investment and the waterfall, that's usually a positive for most investors in most situations, and you would expect the sponsor to have maybe a little larger share. We'll talk about our waterfall in detail here in just a minute, but essentially the last step in our waterfall is a 70-30 split, with 70% going to the investors and 30% to us as a sponsor. And so I think the proper way to view that is we're 70-30 partners with our investors. And our opportunity to benefit is basically after other priority distributions are made, the profits after those distributions are split 70-30. So
That's helpful for those listening. There's going to be some terms I'm sure we'll throw around, and we've also talked about how important it is that the sponsor has some skin in the game with their investors to see the long-term success of the investment, like you just mentioned. So check out AAAStorageInvestments.com. Go to the Insights tab. You'll see tons of other resources and conversations we've had around some of these structures, but it's important to get the details right.
Yeah, and just to point out, I'm talking about, for the sponsor, in this case, AAA Storage, our 30% back-end carried interest is how it's referred to. It's a carried interest because there's no direct investment by us that's required for us to get that 30%. It's basically a performance bonus, if you will. However, just to be perfectly clear, we'll have $10 million of our own capital invested as an investor in Growth Fund 2, subject to that same waterfall and all the other costs that the fund incurs, which is really a whole different, that's our skin in the game, right? The $10 million of our own cash invested side by side under exactly the same terms with our investors. That's our skin in the game. The 30% carried interest that we get is really our incentive comp as the manager of the investment to do a great job for our investors.
That's great. Okay. Thank you for clarifying. That's helpful. Okay. So what else is helpful to know about a waterfall? Thinking about these investors and why I would want to be not careful, but you mentioned, is this fair and right when I'm reviewing a deal, looking at a sponsor and their relationship to the deal? Talk to me about why that, what's going on there, what I should be paying attention to.
Yeah, well, first of all, there are two types of waterfalls, essentially. The American waterfall, the rules in terms of the governance, in terms of the distribution, is applied on an investment by investment basis. So if you're in a single asset investment, you're a part of an LLC, you're an investor that has acquired an existing multifamily project. The American waterfall or the European waterfall, which is the other type, are really applicable because there's only one asset, right? So the American is on an investment by investment basis. The European waterfall is applied at the end or the liquidation of the partnership. So if you're in a single asset deal, either one apply and they function exactly the same. If you're in a multi-asset investment like our Growth Fund 2, the difference is, and we are an American waterfall, is that we distribute the cash subject to the waterfall on an individual investment by investment basis when those investments are sold. If we were a European structure, there would be no distributions until everything is sold.
Yeah.
Or if there were, the investors would get a complete return of all of their capital invested in the fund, not just the capital invested in that one project, before it went to the second step of the waterfall. So one of the advantages from a sponsor standpoint of an American waterfall is that we actually have the opportunity to earn some of our carried interest from each property as it's sold. And we think that's fair. Our management performance really exists at two levels, on a project by project or property by property basis, as well as overall at the entire fund level. So we use the American waterfall. It does allow us to distribute cash at each exit, and it allows us to benefit as the sponsor. But what we do at the back end, because in concept, the American waterfall could have the risk of overcompensating the sponsor. You have one project that goes really, really great, and the GP gets a big chunk of carried interest. The next project doesn't go well at all, and the GC or the GP gets a very small carried interest. But at the end of the day, if you add up what they should have gotten from both combined, they wound up getting more than they should. And so we have a clawback in our waterfall, which is when the last property is sold and the fund is liquidated. The calculation is done to make sure that our compensation never exceeded 30% of the entire portfolio's carried interest. And if it did, then we have to put money back in the fund that goes back to the investors. So the clawback is a common feature in the American waterfall that makes sure it doesn't create any disproportionate advantage for the sponsor in the investment. I think the other thing that people don't know, I'm kind of wandering off here, but it had made a note and I forgot to mention earlier, is that the waterfall actually applies to every dollar of any kind distributed from the investment to the investors. I think people think of it as being applied when the asset is sold. But let's just take an example. Let's say you invested in a partnership that's buying and has bought an existing multifamily property, and you're getting a 10% cash-on-cash return on an annual basis. And the property is held for 10 years. Every dime of those operating distributions would go to you as the investor. And it wouldn't be until the 11th year where any of that money was allocated within the waterfall to the next step, whatever it is in the waterfall. Because these are operating distributions. They're not treated on your K1 as return of capital. But the waterfalls, the way they're written, is it says the investors must receive an amount equal to their invested capital. 100% of all distributions go to the investors until they receive an amount equal to 100% of their, or they get a complete return of capital. And then it goes to the second step in the waterfall. So it can be confusing because people say, well, wait a minute, that's not return of capital. That's actually an operating distribution. It is. But for purposes of calculating the dollars that move through the waterfall and the priority that they're given, every first dollar out is dumped in that return of capital bucket until it's full and overflows to the next bucket, which would be, in most cases, a preferred return. And then that bucket fills up, whether it's from sale proceeds, refinance proceeds, operating distributions, and then any additional dollars go to the third bucket. And so I think I don't know that it's key to understand, but the every dollar that's distributed, no matter the source, that comes out of an investment vehicle is generally subject to the provisions of the waterfall in terms of the priority that's set in terms of the amounts of money that the investors get back.
Okay, just to emphasize the point, I'm going to try to answer my own question. But from the perspective of the investor, listening to what you just said, this matters, helps me as the investor because I know I'm going to. Every investment carries risk. The future is uncertain. But I can be assured by the governance policies of this investment that I should get my money back before the sponsor gets their money. And then we talk about
sponsor
splits
gets
after that.
In most waterfalls, yeah.
Yeah. Okay, so that
I'll
helps
use
me
ours
to feel like there's an assurance that this is a good thing for me.
And in today's world, there's actually the second step in the waterfall is generally a preferred return. I'll use ours as an example. The first step in our waterfall is complete return of capital to the investors. Okay. The second step in the waterfall is a 7% annual preferred return from the date you invested the capital to the date it's being returned to you. And then, and only then, in the third step of the waterfall, does the sponsor get anything. So essentially, that structure guarantees you that you're going to get your money back plus a 7% annual return before the sponsor ever gets a dime.
Okay. Two questions there. One, I've heard, pref, the preferred return. That's an important thing in this relationship. Why? And two, why 7%? Or how do you guys think about why is that a good number to land on?
It's generally in the 6 to 8% range in a average waterfall. There are investments where the capital is being deployed as a preferred tranche in the capital stack. And it's really the only source of return. And in that case, the numbers would look different in the waterfall for the entity making that preferred investment. But within the structure where you're really talking about an equity investment, the first step is generally return of capital. The second is a preferred return. It's sort of marked to the market, Brandon. If interest rates today were at 12%, then pref returns would have to be higher for investors, right? They'd have to get, they'd have to get that 11, 12% return as a preferred return before the sponsor got anything. But in today's market, somewhere in that 6 to 8 range is pretty typical. And we set ours at 7. There's no perfect reason or justification for it. We just felt like that was fair. But if you think about it, let's say you make an investment and it's sold 4 years later. When it's sold, the first thing you're going to get back is the amount you invested. And the second thing you're going to get back is 28% of the amount you invested, or 7% a year for 4 years. If it was exactly 4 years. And then the next step in our waterfall, and in most waterfalls, this is fairly common. If you remember at the very beginning, I talked about us being a 70-30 partner with the investors. So the next step in the waterfall is the sponsor gets a chance to catch up to the investors based on the amount of preferred return that was paid to the investors. So in our waterfall, the third step, first step is return of capital, second step is a 7% annual preferred. The third step is that we get a distribution equal to 30% of the preferred return that was paid to investors. So they get it first. If there's no more there, we get nothing. So it's really downside protection. The worst our investors can do is all their money back. Well, we're not going to see a dime until they get all their money back, plus their 7% annual return. I want to say it the right way. So it's downside protection for them. Once they get that return of capital plus a 7% preferred return annually, we get to catch up. We get 30% of the amount they were paid in pref. So now we're at parity. And every dollar after that, the fourth bucket, when the other three are full and have overflowed in the one below them, the last bucket is a straight 70-30 split.
That's the last bucket. There's 4 buckets. If we're looking at the champagne tower of champagne coming at the top and it's flowing to all, there's 4 layers. Okay.
In our waterfall, there are 4 layers. There are structures that have more than 4 layers, but we chose to keep ours simple. We chose the splits are anywhere from, in a very simplistic model, anywhere from 60-40 to 80-20 in that last step in the waterfall. There are more complicated waterfalls that have return hurdles in them, and I'll go through an example maybe in a second, where the GP can even get to the point where the sponsor can even get to the point where they're getting half of every dollar that comes out beyond a certain return to their investors or more. We chose a very simplistic 4-step waterfall, the last step being 70-30, for a couple reasons. One, for a sponsor with our experience and our track record, it's very standard in the industry. Again, if you're a brand new sponsor without a track record, represents more risk, more concern on the part of investors, you might do an 80-20 split on the back end because you haven't earned the right. It's sort of based on experiences like hiring an employee. If you hire somebody without a lot of experience, you probably get them a little bit less expensively. Our investors are hiring us to manage this investment for them, and our track record and our experience justifies a 30% back in. The other reason we chose 30% is that we think our track record is important. And every deal we've ever done was 70-30 on the back end. So when we give people our track record data and tell them that our investors have had an average 20% IRR over a 33-year period, we want it to be an apples to apples comparison. If the fund had a different sharing arrangement than our legacy deals that we, before we started the funds, it would be apples and oranges. And it really would be a valid comparison. So that was the other motivation when we chose 70-30 that was consistent with what we've done, across all the deals we've done over 33 years. So,
No, it makes sense. First of all, I like simplicity, and I like that you guys kept to a simple arrangement because finance can get super complex. But what you're describing is it seems pretty straightforward. Everybody wins. You've got these, call them hurdles, but you got these kind of movements through the fund, through time, through getting money back that everybody seems satisfied. You guys took on the risk to develop and build the project, set the infrastructure to house the investment. The investors supply the capital, and you guys, everybody wins. It sounds like a really great deal.
Yeah, the right structure, and this is from a due diligence standpoint, if one of our listeners are out there looking at opportunities, I think what you want is you don't want a sponsor who can win when you lose.
Yeah, right.
In our fund structure, the only fund level fee we have is a management fee. And essentially that covers our cost to manage the fund. The only other amounts that we charge the fund are for actual services provided. For example, property management. We have a group of 40, 50 people that are in our project management division, a property management division. And we charge a 5%, it's $1,500 a month or 5% of revenue, whichever is greater, which is as standard as you can get in the industry. The fund could pay us to do that because we have the capability. If we didn't do it, the fund would pay the same amount to a third party, and we would have less control, which would be worse for our investors. So other than that 2% management fee, and I can promise you we ain't getting rich on a 2% management fee. That's the only. So what you're looking for is a sponsor who's covering his cost on the front end and only making profit when you get to that fourth step in the waterfall where he's earned that compensation by creating a return for the investors. So when you see a deal with huge fees up front or some sort of inverted waterfall where the sponsor starts getting dollars before the investors are made whole, that's not a viable structure. I wouldn't suggest investing in a structure that's set up that way.
Yeah, and obviously, this goes without saying, but I'm going to say it anyway because it's a podcast, is if you're seeing lines in the memorandum or in the structure and somebody's like, what is that fee? 2% fee? What is that? And then, Paul, talk to me about this fee. You would walk somebody through all where this shows up, why this shows up, how this fits into this waterfall structure, all that kind of stuff.
Yeah, in fact, we just had a closing a week ago, 10 days ago, right after I came back after having been out for a little bit. So it was actually a week ago. And before he would pull the trigger, he went through the PPM and looked at all the fees, the fund management fee, and then went down through all the fee for service, the actual work we do that the fund would have to pay a third party to do if we didn't have the capability to do it, and question every one of them. And I was more than happy to walk him through each one of them and what we do for those fees and why they're charged and what they would cost in the market if the fund had to go get them from a third party. And so absolutely, we're as transparent as you can be on that and, feel like we've been at this a long time. I don't think you can treat people unfairly and hang around for 33 years.
Yeah, that's right. That's right. And, I like your point. Somebody's going to pay those fees somewhere. And there is if you're paying a third party, there's that coordination tax, that just trying to manage the management. That's you guys kind of take that out because, like you said, you kind of have more control, which helps.
Yeah, if your grass
create
needs
a lot of efficiencies.
Yeah, if your grass needs cutting, you can cut it yourself, or you can hire somebody to cut it. In which of those scenarios do you have more control?
Yeah,
if you cut it yourself,
right.
And so we do all our own development work. We do all our own construction management work. We manage the properties. Those are real services with real value and real cost associated with them that we perform on behalf of the fund so that the fund doesn't have to hire a third party, to do them. So I didn't mean to get off on the fee discussion, but anyway.
It's helpful.
I'll give you one more complex example. I mentioned it. This is not uncommon. I don't particularly love it, but here's an example of a more complex waterfall. And I'm just going to make this up out of whole cloth, but it could look like this. Step one is 100% of any distribution goes to investors until they receive a complete return of their invested capital. Then 100% of all proceeds go to investors until they get their preferred return, whatever rate that is set at. So let's say 7% again. Thirdly, the sponsor gets a catch-up on the preferred return. And then the fourth, fifth, and sixth steps in the waterfall can look like this. The sponsor gets 20%, the investor gets 80%, up until the point the investors have received a total return of 15%. And then the sponsor gets 40% and the investor gets 60%, until the investors have received a return of 20%. And beyond 20%, the sponsor gets half and the investors get half. So you see, that's a tiered waterfall where the sharing arrangement in that last step or steps in the waterfall is contingent upon the return that the investors have received. And that can be a fair structure. It's a little more complex. I'd hate to have to do the calculation. Thank goodness we have fund administrators who, that's what they do. But it also, in some cases, can rob investors of the upside if you get a project or an investment that does extraordinarily well. I'm not saying it's a bad thing or that sponsors that use it are bad, not in any way. I just think it bears a little bit more analysis in terms of, if the sponsor were to get to that 50-50 split level in the waterfall, are you going to be infinitely pleased with the return you got as an investor, or are you going to feel like maybe they got a little more than they should?
Yeah, that's always the risk with long-term investments. If you have an outsized return, is who really benefits over time. And there's always, like venture capital is always known for having these really amazing returns to their investors if they do well. Or you have CEO pay packages like Elon Musk. If he does well with the enterprise value, he gets $1 trillion. But so who wins in the long run? It's always a question. But I like how you guys split it at 70-30.
Question is
fair.
Hard to answer because it really really only can be answered in the context of a specific opportunity. You can't really answer it conceptually. Right. But that's the more complex approach to waterfalls, is adding tiered sharing arrangements that are tied to the investor returns. Would be sort of the more complex style of waterfall that I mentioned a few minutes ago. So
well, what else should investors know if they're listening here, thinking due diligence on their own deals? They might be watching on YouTube, listening on Apple Podcasts. Hey, I got this opportunity. What should I be thinking about? Or thinking about AAA storage investments and Growth Fund 2. I'm looking at self-storage properties. What am I looking about? What am I looking at, and how am I thinking about it?
I think our topic, the focus today is the waterfall. I think it's certainly an integral part of making an investment decision. You want to understand it. You want to make sure that it's fair. I hate to use the word feels because it's a very tangible structure within the investment. But I also say all the time that unmet expectations are the root of all anger. So I think looking at it from the standpoint of, does it feel fair? Am I going to, when this investment wraps up, am I going to feel good about how, the sponsor as my partner and what we each got from this investment? So there's that aspect. And then the other is just a pure analysis. Is the sponsor share and the investor share balanced in a way that actually represents the risk the capital is taking and the expertise that the sponsors bring to the table? Those are really the two components. How much risk are you taking, and how much of a contribution to the success of the investment is the sponsor making? And that's really what should set the balance of that sharing arrangement in a waterfall.
Well said. Thank you. It's helpful. Get the feel, get the balance. Is it fair? Think long-term, think massive upside, think downside, long-term, unexpected, outcomes. How will this feel to you? I like that.
Yeah,
especially given the expertise of the sponsor.
Yeah, in our fund, we have 11 different projects in Fund 2. So the waterfall will be applied 11 different times as each of those properties sold. In fact, I'm working through this exercise with our fund administrator right now. People probably wouldn't think about this, but we actually specifically allocate the specific amount of capital that was invested in a project to that project, along with the timing of when it was invested, so that when that property is sold, we know it, or we don't, we know, but the administrator is really the one that deals with it, exactly how much has to go back to investors for them to get a return of their capital. We know exactly when that capital was called and how long we had it, and it's usually called multiple times, so it's a fairly complicated calculation. So we know exactly how much pref interest they should have earned, which is the second step in the waterfall. And then they calculate 30% of the total amount of the pref that was paid to investors. That comes to us as a sponsor, and every other dollar left in the bucket that you're pouring out of is split 70% to the investors and 30% to us. But it's applied to each property individually when it's sold, so we can distribute that cash to investors. And then at the very end, like I said earlier, there's a clawback, there's a check, there's a calculation that says, if you combined all of these 11 investments into one bucket and you calculated what the sponsor should have gotten, did they get one nickel more than their 30%? And if they did, we have to give it back. And if not, then the last distribution is made and the investment liquidates.
And this is why spreadsheets were created. And I love and am thankful for people that dig into that, because I ain't going to do it. That sounds super complicated in a way,
I'm thankful
to actually model all that out. Yeah.
IQEQ is our fund administrator. They're based in New Jersey, and they're a global company that does this for sponsors of all sizes all around the world. And I'm thankful for them every day, because they do all the stuff I do not want to do.
Yeah, there ain't no way I'm going to be sitting in that model.
That's a lot of detail. That's a lot of detail. So.
That's right. That's right. Well, Paul, thank you so much for walking us through that. I know it's a question that you get often with investors, and I know it's something that comes up in different ways, and it's something that you think about all the time, and how this applies in different cases. And I like the philosophy or the methodology that you have behind it. That, of course, then impacts even down to the governing documents of the fund and the entities. And so, anyway, it's very helpful to understand how you guys are thinking about it and why and where that comes from.
Yeah, and the last little tidbit, I would suggest, if you're making an investment, don't just look at the waterfall in the PPM. I'm sure in almost every case it's an accurate description, but it's a description. Go read the legal language. It's in the LLCA. Go read the actual language, and just from a nuance standpoint, make sure that you really understand that governance, because it is governance. It's a legally binding agreement between the parties and members in that LLC, how this is going to be handled. So it's usually not a long section. I think ours is section 6, maybe has 4 or 5 subparagraphs, maybe a page total. So it's not a long read, but I suggest you actually go look at the governance document itself to make sure you understand the waterfall.
That's helpful. That is called due diligence.
Yeah.
I like that. Well, Paul, thank you very much. I'm looking forward to the next episode. Glad you're back. Glad we're back. And we'll see you next time.
Yeah, absolutely, buddy. Enjoyed it as always.
See you.